a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about oil ETFs. And there have been some absolutely insane moves in oil and related ETFs over the past few weeks. So there's so much investor interest in these products. Millions of dollars have flown into oil ETFs in the past few weeks. So we are taking a look. So last month, Monday, April 20th, was a historic day for oil markets because oil prices for future delivery turned negative. Now, it is difficult to imagine how the prices of any useful commodity like oil can go negative. So let's take a look at the factors that led to this collapse. So we all know that coronavirus-related shutdowns have greatly reduced demand for oil, but demand was going down for various reasons even before shutdowns, and supply had been going up. That's thanks mainly to U.S. shale production. And earlier, OPEC and other oil exporting countries like Russia, they used to cut production to maintain demand-supply balance. But recent cuts were much lower than the fall in demand. That was due to breakdown in the OPEC plus agreement. So at the end of March, there was too much oil stored at sea, in tankers at sea, at land, and storage was just running out. Uh, so now, again, let's take a step back and talk about oil markets. So there are physical markets for oil and there are futures market for oil. So that particular day on Monday, the price for futures contract that was due to expire the following day fell to minus $37 a barrel because no one wanted to take delivery of those futures contracts. Now, some futures require delivery, some do not, some are cash settled. So basically, with those futures, you could get paid to take delivery of oil. Now, since over the past 3 weeks or so, oil prices have rebounded a lot because global economies have started opening up. So people are driving, flying. So many investors are betting on this rebound. And there are two ways you can bet on oil using ETFs. There are oil commodity ETFs that track the futures, oil futures, and then there are oil equity ETFs that basically hold oil producing companies like Exxon, Chevron, Valero. Uh, Now, ETFs and ETNs that bet on oil prices using futures, they are good at tracking the commodity in the short term, but they can perform much worse than the commodity in the longer term due to contango issues. Now, contango issues mean basically the later month future contracts are more expensive than the near months, the ones that are expiring sooner. So let's take a look at oil ETFs, three most popular oil ETFs that track oil commodity using futures, and they also suffer from contango issues. But I wanted to talk about them first, and maybe in some other video about oil equity ETFs, because many investors are pouring a lot of money into oil commodity ETFs, and some of them are not even aware how they work. So let's take a look at three of these ETFs. So the first one is USO, United States Oil Fund. It's the world's largest oil ETF, very popular with investors in the past few weeks. It has, gathered millions of dollars in the past few weeks and has almost $4 billion in assets as of now. And it has made many changes in its strategy over the past few weeks. Earlier, it used to hold the nearest term future contracts. Now it holds a mix of short-term futures contracts on WTI crude oil, has an expense ratio of 79 basis points. Now, to take a look at this ETF, let's go to the quote page on Zacks.com. And you can read our research report articles, and then from there you can go to the external home page for this particular ETF, and you can look at the details, and you can read about the warnings about the volatility in oil markets and what this ETF is supposed to do. And you can also look at the holdings. So now, as I mentioned, that it is now holding a mix of various futures contracts, short-term futures contracts, July, August, September, October, November, December 2020, and then June 21 as well. That is mainly to minimize the impact of contango and reduce the volatility of this particular ETF. Now, the second ETF that is also very popular with investors of late is the ProShares. It's a leverage product. It is called Ultra Bloomberg Crude Oil ETF, ticker symbol UCO. It seeks to provide the 2 times the daily return of an index of future contracts of WTI crude. So remember, this is a leverage product, so it resets daily. So it aims to provide the return of that index, the 2 times return of that index. But if you hold it longer than a day, then those return may be very different from 2 times the return of that particular index. That is because of daily rebalancing, and that you should always remember with these futures-based and leverage products. Being leveraged, it has an expense ratio of 95 basis points, slightly higher. This also has over $1 billion in assets. Now, again, to take a look at this ETF, you can go to the quote page on Zacks.com, read our research report articles, and go to the external homepage, which is ProShares webpage for this particular ETF, and you will see what it holds. It holds a bunch of swaps and futures, and that is basically to provide that leverage. Now, the third one that we wanted to talk about is by Invesco. It is called the Invesco DB Oil Fund. The ticker symbol is DBO. And this is, kind of next generation oil futures based ETF. It tries to minimize the impact of contango through optimizing its contract selection. It has an expense ratio of 78 basis points and has about 425 million in assets. Now, all these are expensive products because they use futures. One of them uses leverage. So they are meant for short-term holding only. They are not buy and forget products. The equity-based products like XLE and XLP, you can hold for a much longer time. Now, again, to take a look at the ETF, you can go to the quote page on Zacks.com, and from there you can go to the external homepage, the Invesco webpage for this particular ETF, and you will see that it holds a mix of futures contracts, various future contracts on oil. Now, as I was trying to emphasize that these products, they are very volatile products, and their performance can be much more volatile due to contango impact and the impact of leverage than the volatility in oil itself. So at the beginning of this year, oil was around $61 a barrel, and it is down more than 50% from there, despite the recent rebound. So let's take a look at the performance and oil is down a little over 50% this year. But these ETFs, if you look at the year-to-date performance, they have done much worse because of contango and leverage issue in case of UCO. So in fact, UCO is down more than 97% year-to-date. Basically, you would have lost all your principal if you had invested in this ETF and held on to it. USO is down almost 80%, whereas DBO is down about 45% year to date, and S&P 500 is down about 10% year to date. Now, I also took a look at the performance since oil started rebounding about 3 weeks back. So over the past 3 weeks, the leverage product has done the best. Of course, it is up about 45%, whereas the Invesco product is up about 15%, and USO is up about 7%, basically the same performance as the S&P 500 ETF. So that's all we have for today. Thanks for watching, and I'll see you next week.